Let me ask you something. You've studied a stock, done your research. You know it's overvalued, but everyone around you is buying it. Your friends are making money. Your Twitter feed is going crazy. So what do? You buy it. Of course you do. And then it crashes, and you lose money. Now here's the scary part. That wasn't bad luck. That wasn't the market being unfair. That was your brain, working perfectly as designed, just completely wrong for investing. Today, we're going into behavioral finance, the science of why smart people make dumb money decisions, and more importantly, what you can do about it. This is Stonk's Logic. Let's get into it. Traditional finance assumes something wild, that investors are rational, that they always make logical decisions, based on data, probabilities, and cold, hard numbers. Behavioral finance says, it's a field that combines psychology and economics to explain why we actually make financial decisions, which, spoiler alert, is mostly emotional. Two psychologists, Daniel Kahneman and Amos Tversky, basically broke economics in the 1970s by proving that humans are predictably irrational. Kahneman even won the Nobel Prize in economics for it. Not bad for a guy who never took an economics class. So today, we're covering the 5 biggest behavioral biases that are quietly destroying retail investors, maybe even you. Bias number 1, loss aversion. Here's a quick experiment. I'll give you 2 choices. Option A, you get 5,000 for sure. Option B, you flip a coin. Heads, you get 10,000. Tails, you get nothing. Most people pick option A, even though mathematically, both options have the exact same expected value. Why? Because losing feels about twice as painful as gaining feels good. Kahneman called this loss aversion, and it absolutely wrecks investors. Here's how it shows up in real life. You buy a stock at 500. It drops to 350. Instead of cutting your losses, you hold. Because selling means admitting the loss is real. Meanwhile, if that same stock had gone up to 650, you'd probably sell too quickly, locking in the gain, before the market takes it away. The result? You hold your losers too long and sell your winners too soon. Exactly the opposite of what you should do. Bias number 2, herd mentality. Remember GameStop in 2021? A dying video game retailer with no real future. Suddenly worth billions because Reddit went crazy. People who had never invested a single rupee in their life were dumping their savings into a meme stock. That's herd mentality. We are wired, literally wired from evolution, to follow the crowd. In prehistoric times, if everyone ran, you ran too. No questions asked. In investing, that instinct is poison. Bull markets make everyone look like a genius. You see your neighbor, your uncle, your college batchmate, all making money on the same hot stocks. So you jump in, right at the peak. And when the crash comes, you're the one left holding the bag, while the smart money already exited. Bias number 3, and this one's personal, overconfidence. Studies show that 93% of drivers think they're above average drivers, which is mathematically impossible. The same thing happens with investors. After a few good trades, maybe you caught a rally, maybe you bought something that doubled. Your brain tells you, I've figured this out. I'm good at this. And that's when you start putting bigger amounts into single stocks, trading more frequently, ignoring risk because you know what you're doing. Here's the brutal truth. Most retail investors underperform a basic index fund over the long run, not because they're dumb, but because overconfidence leads to overtrading. And overtrading means more fees, more taxes, more mistakes. The best investors in the world, people like Warren Buffett, are obsessed with what they don't know. Humility is literally a competitive advantage in the market. Bias number 4, anchoring. You bought a stock at 1,000. It's now at 600, down 40%. Someone asks, would you buy this stock today? If you're being rational, the question is simple. Is this stock worth buying at 600 based on its fundamentals today? But your brain doesn't work like that. Your brain is anchored to 1,000. So you think, it's cheap now. It'll bounce back to 1,000. But the market doesn't care what you paid for it. 1,000 is just a number in your head. This is anchoring. When we rely too heavily on the first piece of information we received, it works the other way too. This stock used to be 5,000. It's only 800 now. It's a bargain. Not necessarily. Some stocks fall for very good reasons. The price history is not a promise of the future. Bias number 5. Recency bias. Whatever happened most recently feels like what will always happen. Market's been going up for 2 years. Bull markets last forever. Stocks only go up. Market just crashed. Everything is terrible. I'm selling everything and never investing again. Recency bias makes us extrapolate the recent past infinitely into the future. It's why people pile into markets after long bull runs and panic sell right at the bottom of a crash. Literally the worst possible timing. Every single time. The 2020 COVID crash, the market dropped 35% in a month. Millions of people sold in panic. Then the market completely recovered in 5 months and went on to hit all-time highs. The people who held made life-changing returns. The people who sold at the bottom locked in massive losses. Okay, so your brain is basically a liability in the stock market. What do you actually do about it? 1. Have a written investment plan. Before you buy anything, write down why you're buying it, what price you'd sell it if it goes wrong, and what you expect over what time horizon. This creates a rational anchor before emotions kick in. 2. Never check your portfolio every day. Seriously, the more you check, the more you react. Loss aversion hits harder when you see every dip in real time. Successful long-term investors check quarterly, not daily. 3. Automate your investments. Set up a SIP or automatic investment on a fixed date every month. When it's automatic, your emotional brain never gets a vote. 4. Find a devil's advocate. Before any big investment decision, find someone who will argue the other side. This fights overconfidence and herd mentality at the same time. 5. Study market history. Recency bias weakens when you know your history. Read about past crashes and recoveries. When you know markets have always recovered, the next crash feels less like the end of the world. Here's the thing nobody tells beginners. Investing knowledge is only half the battle. The other half is knowing yourself, your fears, your impulses, your blind spots. The best investment you can make right now isn't in a stock. It's in understanding your own psychology, because the market will test you. It will scare you. It will excite you. It will make you greedy. And when that happens, I want you to remember this video. If you found this useful, subscribe. We go deep on investing, markets, and personal finance every week in a way that actually makes sense. Drop in the comments, which bias do you think you're most guilty of? I'll bet loss aversion wins the poll. See you in the next one.